in sync, but one may be surging more or falling more.
That's right. Between now and 2012, there will be periods when silver and other metals do better than gold. But when all is said and done, you will find that gold is, by far, the single best performer because of its value as a hedge against the dollar.
So what's behind this cycle in the gold?
It parallels the cycles in the U.S. dollar. And for the dollar or for its proxies, we have cyclical data going way back to 1680.
Back to 1680
was the price as the ugliest.
The real decline in the dollar and all currencies will show up more clearly in the doubling of the value of gold we just talked about.
Yeah.
Measured against gold, the dollar's purchasing power will fall by half or more, depending on, of course, on the intensity of the global selling that hits the greenback.
What about oil and other commodities?
Oil will not return to its all-time highs. Unlike gold, it is driven less by currency disasters and more by consumer or industrial demand.
Demand, okay.
And we simply do not see high demand being sustained through this period.
So it would be a mistake to overinvest in commodities or commodity stocks right now.
Yes, I agree.
And most commodities won't surge as far because of what?
Because the U.S. economy will sink into another recession.
Similar to the recession of 2009?
No, probably worse.
Okay, again, the timing question, when?
Not right away. Our cyclical data on GDP and on consumption point to a material improvement in the U.S. economy.
Okay, so you see the economy actually improving for a while.
In the first of 2010.
Okay. Mm-hmm. But you see the stock market falling while the economy is still improving. Why is that?
Yes, the stock market anticipates the economy, and starting in the second half of 2010, GDP growth will start to sink fast, and we could see negative growth by the beginning of 2011. The worst period for the economy will hit in the fourth quarter of 2012.
Why is that? What's driving the economy down?
You don't have to look very far to see the reasons.
Trillion. Would you care to guess what the government forecast was for this same deficit just 2 years ago?
A lot less, I presume.
Yes. Mike Larson, looked back at the forecast made by the Congressional Budget Office, the CBO, 2 years ago. The CBO predicted that the U.S. deficit for this year, for 2010, would be about $250 billion. Now it's coming in at $1.6 trillion, 6 times more than they forecast.
They didn't expect the deep recession that struck in 2009, though.
Much like they're not expecting the double-dip recession that Richard's talking about starting next year.
Right.
My point is that just like their forecast was dead wrong for this year, it's probably going to be dead wrong again in coming years. And for 2010, let's look at 2012. Let's look at 2012. The Obama administration is making some very aggressively optimistic assumptions for the U.S. economy. And based on those assumptions, it's forecasting a deficit of $829 billion. Only, quote, only $829 billion. Instead, if the economy is sinking, we estimate the deficit for 2012 could be over $2 trillion.
Yeah, but some people may think that these huge blunders merely reflect the government's forecasting errors.
Oh, it's much more than that.
Politicians know they're rigging the numbers, and they're swearing on a stack of Bibles that's an honest estimate. No matter what, the big risk is that global investors will sell U.S. dollars wholesale.
And they can't sell the dollars in a vacuum.
Exactly. Along with the dollars, they also have to sell the assets where they're holding the dollars.
Right.
Especially the long-term Treasury bonds.
What does that mean?
You could see a massive plunge in bond prices.
Translate that into bond yields.
You'll see a major spike upward in yields. That could give investors a huge buying opportunity to lock in those high yields for years to come, provided, of course, that price inflation does not run rampant. And secondly, more importantly, the U.S. government is still a safe bet at that time.
Let's hope it is.
The U.S. government in America faces a great historic test, a test of our power.
Our willpower.
That's right. Our willpower as a nation.
Please explain what you mean by that in terms of cycles.
The great test of our country, an Armageddon of sorts, will come in the year of maximum turmoil in the financial markets, the time of peak tension in society, dab in the middle of a sweeping transition already underway in our longest term cycle. in probably the most important cycle that we've found.
Which is what?
It's the 500-year geopolitical cycle. We've mapped it all the way back, clear to 670 BC.
Almost 3,000 years.
That's right. And it's a broad, far-reaching shift in power, wealth, and money from east to west, or as in this case, now from west to east.
Well, we've talked about this before.
Yes, but I want to add that we're not only talking about a power shift from west to east, we're talking about a major wealth shift from old fortunes that are destroyed to new ones that are created, from countries, companies, and families that were dominant for so many decades to new ones that replace them on the other side of this massive upheaval.
Well, provide those families are well prepared ahead of time.
And provided they use reliable signals with prudent risk controls. No matter what you invest in or how you invest, the real possibility of losses is something you always have to be aware of.
That's very important. Very important.
Very, very important.
Yeah. On our blog, though, many readers tell us they make decisions largely based on gut, which to me implies not only some analysis, but also intuition and emotion. They admit that more often than not, that's their basis for deciding how much to invest in each class and when.
Right.
Now, what would be your allocation right now to those 5 asset classes based on your analysis of the Foundation's work?
Step number 1 is to diversify across all 5 asset classes.
Right. Years ago, though, it would have been virtually impossible for the average investor to do that. I mean, you'd need a lot of money to do it. You'd need to take a lot of risk. You'd have to be dealing in futures or even in currency markets.
Or margin accounts, etc. True. But today, all 5 of those asset classes are readily available to average investors through hundreds of exchange-traded funds, or ETFs, as if it were a panacea. But it's not for 2 key reasons. The notion of diversification is spreading your money among several different U.S. stock sectors.
Just in stocks.
Right, and that's not going to work because nearly all stocks are linked in some way. In a truly diversified portfolio, stocks are just one of 5 asset classes.
Plus, Wall Street still seems to assume we're back in the 20th century. And in the 20th century, you had bull markets which were very, very long in duration. Then you had bear markets that were very, very short-lived.
Correct.
So that's not the case today anymore, is it?
No, it's not, which is actually the key to step number 2.
Okay.
You must recognize that in today's era, especially as we head towards 2012, if you want to make money, you must not rely exclusively on up markets. You must also take advantage of down markets.
Right. And that also used to be hard for the average investor to do. I mean, they had to sell short, they had to have margin accounts.
Right, but not anymore. In every one of the 5 asset classes, ETFs are readily available, whether you want to profit from rising prices or you want to profit from falling prices.
Not many people know that. They know they have ETFs for different asset classes.
Right.
But now on top of that, you have ETFs in those asset classes for down markets too.
That's correct. They call them inverse ETFs.
Right, okay.
You never have to sell stocks or commodities short anymore. Your goal is strictly to buy them low and sell them high like any ordinary stock.
Okay, step number 3.
Step number 3 is to diversify dynamically. Don't just keep a fixed amount of money in every asset class all the time. Sometimes you'll want a lot more, and sometimes a lot less.
Give us an example.
Let's say the foundation signals say that gold is going to greatly outperform stocks and bonds.
Okay.
You may need to double the percentage of the portfolio in gold.
Okay, that's one example.
Right. Or let's say we see a major decline coming in long-term bonds, as I had mentioned earlier. You'll probably want to clear out of long-term bonds entirely. The next step is to periodically rebalance the portfolio.
Rebalance.
Right.
Give us a hypothetical case of rebalancing.
Let's say you go ahead and double the gold allocation from 10% to 20%.
Right.
Then, let's say gold itself doubles in value. You could find yourself with 40% of your portfolio value in gold.
That's a good problem to have.
Sure it is. But you still have to do something about it. You can't sit back. I'm talking about an additional layer of risk protection.
Okay.
You also need stop